All right. So we are going to do the practice of the consolidation, and we have a question from the BPP. You can find the BPP kit in your F7 folder. I have put it over there. So you have the question pedantic, and it's an amended question from December 2008. First of all, let's go to the requirement. Requirement is quite simple. You have to prepare the consolidated statement of financial position. And as you know, I have already sent you the Excel format. Okay, this Excel format is basically an aid to solve the question, but in exam you have to solve yourself and make sure you are able to make the spreadsheet in the exam. So let's go to the question first. On April 20x8, Pedantic acquired 60% of the equity share capital of the Sophistic in share exchange of 2 shares in Pedantic for every 3 shares in Sophistic. So first of all, there is a share exchange. We have already studied that, and let's calculate this. In order to calculate that, we need to know the number of shares the subsidiary has. Okay, first of all, the total number of shares the subsidiary has is 4,000. 4,000 is the balance, but you see it is $1 share, so that means the shares are even 4,000. So the total shares are 4,000, and you have acquired 60% shares. That means 6 for the 2,400. You have acquired 2,400 shares. So share capital of Sophistic in a share exchange of 2 shares for 3 shares. So the fraction is 2 divided by 3. So this is the fraction. Let me just take out my calculator to solve it. All right. Okay. Then you have at the date the retained earnings of Sophistic were 5 million. These are the retained earning at acquisitions. The issue of the share has not yet been recorded by Pedantic. Okay, fine. At the date of acquisition, shares in Pedantic had a market value of $6. So the market value is $6. We multiply it by $6. That gives you, okay, 2,400 multiply by 2 divide by 3. It gives you 1,600 shares first of all, and we multiply it by 6. It gives you 9,600. So the consideration is the 9,600. You know how we're gonna pass the entry. So it's debit cost of investment 9,600, credit share capital, and we credit the share capital by par value. So the shares were 1,600. Yeah, share was 1,600. 2,400 multiply by 2 divide by 3. Yeah, 1,600. So it is 1,600 multiplied $1, and the rest is the share premium. So 9,600 minus 1,600 is 8,000 is the share premium. So this is how we have solved. Below are the summarized draft statement of financial position of the both companies. You have the property, plant, equipment, you have the current assets, you have the total assets, you have the equity, share capital, retained earnings, which is at the reporting date. You have the 10% loan notes. At the date of acquisition, the fair value of the Sophistic assets were equal to their carrying amounts, with the exception of an item which had a fair value of 2 million excess of its carrying amount. Okay, that means it's a fair value adjustment of 2 million above the carrying amount. It had a remaining life of 5 years at that date. Okay, can you see we have acquired the shares on 1st April, and the year end is 30th September. That means it's a mid-year acquisition. So we have April, May, June, July, August, September. We have only 6 months. Okay, fine. It had a remaining life of 5 years. Sophistic has not adjusted the carrying amount of its plant as a result of the fair value exercise. Okay, they have not adjusted that. Sales from Sophistic to Pedantic in the post-acquisition period were 8 million. Fine. Sophistic had made a markup on the cost of 40% on these sales. Pedantic has sold 5.2 million of these goods by 30th September at a cost to Pedantic. Okay, sales from Sophistic to Pedantic in the post-acquisition period were 8 million. Fine. And Sophistic had made a markup on 5% of these sales. Okay, if you see the total sales were 8,000. It is quite mentioned over here. There are sales from Sophistic subsidiary to parent in the post-acquisition were 8 million. Pedantic had sold 5.2 million. That means the 5,200 of these goods have already been sold to the third party. So what we're going to do is 8,000 minus 5,200. It gives you 2,800. So the 2,800 goods are still in stock. So this 2,800 has the profit as well. So this 2,800 represents 140% because this is the sales value, and we need 40% because that is the markup. So what we're going to do is 2,800 divide by 140 and multiply it by 40. It gives you 800. So 800 is the unrealized profit which is in the stock. So as a subsidiary has sold to the parent, so we are going to deduct it from the working number 2. Sophistic trade receivables at 30th September 20x8 includes 6 lakh due to Pedantic, which did not agree. This is due to a cash in transit, so their intra-group balance was 6 lakh. We have to eliminate it. So first of all, we need to adjust their balance due to cash in transit. So the entry is going to be debit cash by 200,000 and credit receivables by 200,000. First, we're going to adjust it, and then we're going to pass this 600,000 entry, which will be debit payables, credit receivables 600,000. Pedantic has a policy of accounting for the non-controlling interest at the fair value. The fair value of the non-controlling interest was estimated to be 5.9 million, and there is no impairment of the goodwill. So now we have read all the question. Let's go to the worksheet. First of all, we already know that the group structure is 60% because that has been given. First of all, let us solve the working. Come to the subsidiary. Share capital was, if you remember, it was 4,000. Yes, 4,000, and it does not change as we already discussed in the lectures. It does not have the share premium, and the retained earning was 5 million if you see at acquisition. So it's 5,000. Okay, because we are taking the figures in the 000. Okay, and then you have the retained earning at reporting date is you have been given this 6,500. Let's put it over here, 6,500. And then yes, there was a fair value adjustment. Yeah, the fair value adjustment was 2,000 in excess of its carrying amount. So we're going to write the 2,000 over here and 2,000 in the post acquisition as well, because obviously this 2,000 will go to the reporting date as well. But you're going to deduct the depreciation from the reporting date because obviously this 2,000 will be further depreciated. So they said that the depreciation was, the life was 5 years, so 2,000 divided by 5. But as I said that this was a mid-year acquisition. We acquired on 1st April and the year end was 30th September. So only we have 6 months. So you're going to take the depreciation of 6 months only. So it's 2,000 divide by 5 into 6 divide by 12. It gives you 200. So the depreciation is 200, which will be deducted from the reporting date. Yes. Okay, now you have the unrealized profit. We have already calculated that. It was 800. It has been sold by subsidiary to the parent. Fine. We're going to deduct 800 from the reporting date because it has been sold by the subsidiary to the parent. We have no other adjustment, then we can simply calculate it. It gives you 11,000, and this gives you 11,500. So 11,000 and 11,500. Okay, the difference, which is the post acquisition, is 11,500 minus, we're going to deduct 11,000 is 500. So 500 is the post acquisition, which will be shared between the NCI and the parent. NCI and the parent. Okay, as the parent is 60%, So 500 into 60 gives you 300, and the other NCI is 200, so it is shared in this percentage. Then you come to the goodwill. We does not have the loan note, we only have the share exchange. Okay, that is fine, we only have the share exchange. So the share exchange was already calculated, which was 9600. If you see this amount, fine, we only have the share exchange 9600. And add the non-controlling interest which have been given to you in the notes, which was 5.9 million, which is 5900. And then you have the net assets which have already been calculated is 11,000 less 11,000. Okay, so they're saying there's no goodwill. Let's leave it. There's no impairment, sorry. Let's leave it and then we calculate it. So the goodwill is 4,500. Fine. So now let's go to the NCI at acquisition was 5,900, and the post acquisition share of the NCI we have already calculated was 200, and there's no impairment. So this gives you simply 6,100. Then you have the group retained earnings. First of all, we need to take the parent's retained earning. We are going to back to the balance sheet. The parent's retained earning is 35,400. Fine, 35,400. And the post acquisition was 300. Yes. And is there any impairment? No. Is there any unwinding? No. Is there any acquisition cost? No. Is there any associate? Is there any other gains or losses? No. Whether the parent have sold the goods? No. So simply it gives you this figure is 35,700. So now we are done with the whole of the workings. Let's go to the balance sheet. First of all, we have the property, plant, and equipment. Let's go back to the balance sheet. Okay, the property, plant, equipment is 40,600, 12,600. Okay, 40,600 plus 12,600, and then you have to add the fair value adjustment, which was 2,000, and minus 200, it's depreciation. So it gives you 55,000. Then you have the goodwill, which have already been calculated as 4,500. Let's put it. 4,500 is the goodwill. There is no investment other than parent in the subsidiary and the investment in associates. And then you have the current assets which have been given in total. Current assets are given in total. Let's take the total. It's 16,000 plus 6,600. So first of all, write 16,000 plus 6,600. Okay, that is fine. Now we are supposed to do some adjustments, which we did over here. First of all, we're going to add the cash of 200. Let's add the cash of 200. That was the cash in transit. Then we're going to less the receivables corresponding, which gives the zero effect ultimately because we have the current assets in total. And then we need to less the intra-group receivable as well, which was 600. So let's less 600. So the current assets are 22,000. So now it gives you the total assets of 81,500. We are supposed to take the share capital and share premium of parent only. So as we can see, the share capital was 10,000, but in this 10,000 we have already issued some shares. Let's go back and see how many shares it was. Yeah, so it was 1,600 the share capital and 8,000 was a share premium. So share capital was 10,000, which was mentioned in the balance sheet, and then the further issued was 1,600. 11,600, the share premium was 8,000. The retained earning we have already calculated, 35,700 from working number 5. And we do not have other reserves in this question. Yes, NCI we have already calculated from working number 4. It is 6,100. It gives you total equity of 61,400. Then let's go to the loan. Whether we have the loan. Yes, 3,000 plus 4,000 is the loan. It gives you 7,000. 3,000 plus 4,000. 7,000. Then you have the current liabilities, which I have already given in the total. It's 8,200 plus 4,700. And we're going to deduct the intra-group payable as well, which was 600. Yeah. So now we are done. Now we're going to take the total of equity and liabilities. It gives you 80,700. Did we miss something? Let's check whether we have, okay, the current liabilities. The total equity was 11,000. Did we miss anything? Let's check it. We were having the property, plant, and equipment of 55,000. Let's just check it. So it was 40,600 plus 12,600 plus 2,000 and minus 8 was 200. It's fine. Then we have the goodwill, which is 4,500. It is fine as well. And then we were having the current assets. Current assets was 16,000 plus 6,600. That is fine. And it was oh yes. We missed one thing. We missed one thing. Yeah, the unrealized profit from inventory, which was 800. Let's just deduct it now. It's fine. 80,700, and yes, 80,700. So we just missed one thing, which was unrealized profit, because we are supposed to less it from the inventory. Because here in this question, we were having the complete current asset. That is why we just missed it. Otherwise, in the exam, you will be having separate inventory, trade receivables, and the bank. Yeah, so we are done with the pedantic.